Good morning, everybody, and welcome to this webinar. I'm delighted to be joined by Rik Heap of Leonard Curtis. And as usual, what we have is these sessions are all very interactive. I'd like people to shout out, ask questions. You can interrupt Rik. I'm sure he's quite happy for that. And ask anything you like about insolvency and solvency, what you can do to protect yourself. You don't necessarily need to be insolvent to be able to do this. And just get as much information out of it as you can. As usual, we start with our usual disclaimer that the following presentation is produced for general guidance only, and professional advice should always be sought for any transaction is undertaken. Individual circumstances can vary, and therefore no responsibility can be accepted by Harts Limited or any of their affiliates for any action taken or any decision made to refrain from action by attendees of this presentation. Terms and conditions read out. We've got plenty of other resources as well, so follow us on LinkedIn. There's loads of stuff coming out on LinkedIn every day, Monday to Friday. Have a follow of us on there. We're also on YouTube, so if you want to catch up on any of the slides here, you'll be able to catch up on YouTube later on. This session's been recorded and will be uploaded to that. We're also on X, so again, follow us on that. And we're on Spotify, and where we've done some podcasts, and you'll be able to catch up on those. If you're bored on the way home, you could be able to do that. What we've got coming up, 12th of March, we have our budget update. That's our next webinar. The budget is on the 6th of March. On the 12th of March, you'll have Chris Bentley, who will be giving the budget update. I will be on my holidays, so I'm handing over to him to be able to do it. And then on the 20th of March is our usual business club lunch. So feel free to join us on that. It's normally a great networking sessions. We have 50 to 60 people at Holland Hall. If you go to our website, book on via the events page, it's well worth joining us for that. And you can also have the opportunity to speak to the audience and tell them all about what you do. And our current update, I've briefly mentioned this to people prior to us recording the session. Double cab pickups, this has been snuck out by the revenues. So as from 1st of July, if you own a double cab pickup, it will be treated as a car for benefit in kind purposes. That applies to any new pickups, double cab pickups, which you purchase after the 1st of July. Any existing ones you have until 2028. And then they will revert back as cars. So it's something, if you're thinking of buying a double cab pickup, which have been quite popular for certainly in the construction industry for people wanting to have a van. It now have to be you just now have to watch that. We also have landlords. The Let Property campaign is ongoing. Make sure that you declare all your income and so on. This is still happening. There's plenty happening with that. So again, just make sure that you are declaring all your income. If you need any help in disclosing anything, then please feel free and we can help you with that. Research and development claims. Research and development claims are getting looked at. Ismail, if you could just mute yourself, please. R&D claims are getting closely looked at. There are a number of inquiries starting on R&D claims. So please make sure that you do that. Just bear with me one sec. Right, I've muted him, that's fine. So again, if you've got any problems with R&D claims, just get in touch with us. We'll be able to help you out, but they're not going through as they used to be. So it's something you need to be aware of. And then we're still offering our great planning sessions for clients. So if you want to have a planning session, look at where you are now, where you want to be in, say, 5 years' time, and then we can plan a route of how to get there. It's a great way of working on your business rather than in it, and it gives you great focus and so on. If you want to book in a session, feel free to do so. If you want to download the ebook from our website on taking a fresh look at your business, just pop in your email address, download the ebook, and it gives you a bit more information about what it's all about. So I'm going to stop sharing now. I'm going to hand over to Rik Heap of Leonard Curtis. Rik Heap is Keep Fit fanatic, triathlete, Ironman, but it also means that he can run away from the revenue fairly quickly. And I'm sure he's had loads of years of experience of working in the insolvency game. And he's going to hand over to you now, Rik. So over to you.
Matt Clayton.
Thanks very much, Stephen. Hopefully you can see my slides. Just checking that's okay. Yeah, brilliant. Okay, yeah, thanks for the introduction. Yeah, the Iron Man stuff is unfortunately in no way relevant or useful to what we're going to be talking about today. But there you go. Yeah, thanks to Stephen for inviting me to speak to you today. My name's Rik Heap. I'm a director at Leonard Curtis. The theme of what I'm going to talk about is retaining control during challenging economic times. Just a little bit of background if you're not familiar with Leonard Curtis. We're a national business advisory firm. We now have 28 offices, the nearest ones to here being Manchester and Stoke. We recently opened a Stoke office middle of last year, but also slightly more further afield in Guernsey and Jersey. We've got 280 employees, 30 odd insolvency practitioners, of which I'm one. And crucially, we're not part of an accountancy practice. We work with firms like Harts. As Stephen and the guys know, we're very much independent, very much hands-on and director-led. What makes us different? Well, we're about very much more than just insolvency. That's not a cliche. We have a wide range of service lines that are aimed at helping businesses to avoid insolvency and be rescued wherever possible. We have a team that specialises in helping businesses to raise commercial finance. We have a team that specialises in negotiating time to pay arrangements with HMRC. And we also have our own legal firm that provides the full range of corporate and commercial services. So we're not just a firm of liquidators. There's an awful lot more to us than that. You can see there just a little snapshot of what we're about. And that really, I'd say, sits under our kind of three pillars of funding, restructuring and insolvency, and legal. The core of our business is helping businesses in distress. Now, I'm not saying that any of the people that are on this webinar today are in distress. We've got some really, really good businesses here today. But it's clear that we are still in a time of real economic difficulty and uncertainty. And so Stephen asked me to talk to you today about a little scene in the market and a few things to consider so that you as business owners are best placed, I guess, to deal with some of the challenges that may well be coming down the line. So before I talk about what we're seeing in the market now, let's just give it some context by rewinding a handful of years to what we saw during the COVID times. It's not that far ago now, but it was clearly a very different time to what we're seeing now. Not that long ago, in the kind of the years after COVID or sort of during and around COVID, what we saw was a real lack of pressure, and that massively reduced the number of insolvencies that we saw. And that was principally down to the unprecedented levels of support that we saw during that time. We saw things like the government schemes like furlough and the VAT deferral, things like that delayed cost from businesses or removed it altogether. We had access to a whole raft of new types of funding. We had CBILS, we had bounce back loans, the recovery loan scheme, a variety of grants for both businesses and individuals. So that put new cash into the system that wasn't there previously. We then had some changes to the legal system that prevented creditors from really being able to do a great deal. You know, for most of that time during COVID, the courts were shut. So people couldn't really issue many winding up petitions. And if we've got any landlord clients on the call today, you will know that your hands were massively tied during that period. Landlords couldn't really do much where they wanted to try to, get money back or take action against their tenants. But as well as that, we had, and we will all remember it, a generally much more supportive environment. And that applied to business as well. We were all in these uncertain times where nobody knew quite what was going to happen. And that just bought time. People were much more supportive of each other. And then the final thing on there was that we had, up until the summer of 2021, we had the suspension of the wrongful trading rules within the Insolvency Act. And that just removed some of the worry from those directors who could see that the business was losing money in this crazy time of COVID. But at least by suspending the wrongful trading provisions, it removed some of that worry that they feared they might have been doing something wrong, and they might get some criticism in the event that the business hadn't survived COVID. So that's a little bit of context to what we saw during that time. If we roll that forward to what we're seeing now, well, apart from the recovery loan scheme and a little bit of support around energy costs, all of those government schemes have ended now. In terms of winding up petitions, and I'll touch on this in a minute, those restrictions ended in a couple of phases at the end of 2021 and the start of 2022. And as I'll show you on the next slide, we're now very much playing catch up when it comes to winding up petitions. As you'd expect, there were some pretty chunky liabilities to HMRC out there. Again, HMRC were one of those creditors who politically, I guess, had to be seen as being supportive. Time to pay arrangements were available and still very much are, but I'm sure Stephen will agree from some of the work that the guys at Harts do, you know, it's more challenging to get HMRC to agree to time to pay arrangements.
It's just as challenging to actually get through to HMRC at the moment as well.
Well, there is that as well.
Yeah.
I mean, just on the HMRC stuff as well, and again, we've worked on some of these. HMRC are still very much pursuing legacy tax schemes, and Stephen and I were talking about this very topic a few weeks back. You know, I think there's a change coming now where the time for negotiating or arguing over the legalities of some of those tax schemes, I think, is coming to an end now. And you know, we've effectively got a number in a box for many companies and individuals, and that number in lots of cases is still too big for them to pay. I think we're going to be seeing more where we are advising business owners and individuals in terms of, you know, how they go about dealing with the number in a box that is too big for them to just simply write a check on. So that, I think, is going to continue to be an issue. And then the final point, and Stephen's already mentioned it, about R&D claims. HMRC are tarring all accountants, including the good ones like Harts, who are doing proper R&D stuff. They're being tarred with the same brush as the kind of the factories, that some of these cowboys out there who were just you know, doing very high level R&D claims and giving the profession a bad name. And undoubtedly, as Stephen said, that's making life more difficult for proper professionals, because those R&D claims, albeit they're absolutely, you know, rock solid and properly done, are just being more closely looked at by HMRC. So, and that's going to be a challenge, I guess, more for Stephen. Just looking at funding in terms of cash, you know, access to cash, still very much available. We're seeing that's both from the high street banks and also the secondary lenders. What is still very evident out there is that those funders expect, and have always expected really, good quality and timely management information and forecasts. And that's something that we've seen through our brokerage, that business owners aren't always able to provide decent quality MI. So again, I would just, you know, make the point that if you're looking at going to market to raise some additional finance, then make sure that you're speaking to Stephen and the team and making sure that you're able to present really solid, good quality accounting information. Just a point there that again links funding with what HMRC are up to. You may or may not be aware that there was a change in the insolvency rules at the end of 2020 that effectively gave HMRC secondary preferential status. So going back a good few years now, HMRC were a preferential creditor in insolvency terms. That then was taken away 20 years ago. But at the end of 2020, that's sort of come back. So HMRC now have a secondary preferential status for effectively for the taxes that they collect on behalf of somebody else. so VAT and pay-as-you-earn and NI typically. And what that means now is that in an insolvency scenario, HMRC for that bit of it now sit above the bank's floating charge. So when we are divvying up the money in an insolvency, there's an order of priority, and HMRC now are sit above the bank's floating charge. So where a bank has got security over a property, that's fixed charge, and that's fine. That's not affected by this. But where the bank is then expecting to be able to recover some of their debt through other assets, floating charge assets like stock or vehicles or something like that, that's a real concern for them now, because they have no visibility necessarily over how big that tax debt might be. And so in an insolvency, they suddenly might see a great big chunk taken out of those floating charge assets that they were looking to rely on. What does that mean in reality, I hear you ask? Well, that's impacting on new funding, because what we're seeing is that banks are now pushing customers away from overdrafts and into invoice finance facilities. You may well have been, sort of having those kind of conversations. The reason for that is that where a bank put an invoice finance facility in place, they effectively have ownership over those debtors. So that's unaffected by any liability to anybody else. So you can understand from the bank's point of view why they would rather their lending is all secured by things that they have control over. So we're very much seeing that making life a little bit more challenging in our funding world, where the banks are very much saying, yeah, we'd rather you didn't have an overdraft, and actually we're going to withdraw that and introduce you to our invoice finance colleagues to give you what we consider to be exactly the same thing. So don't worry about it. But actually, it is clearly making things tough or tougher for businesses out there. The other thing that we're seeing in the current climate, obviously the economy. No presentation like this would be complete without talking about the economy. I read this morning that we've now officially gone into recession, because the Q4 numbers have been announced, and we did actually contract in both Q3 and Q4 of 2023. So technically, that puts us into a small recession. And even for successful businesses, that's undoubtedly making things tough. We were talking about it before the call, interest rates, or we've had obviously significant rises in interest rates over many months. That's caused real challenges for both businesses and households. And while those, the interest rates seem to have stabilized now, and we're hoping that those interest rates will start to reduce later this year or next year, we've still got higher interest rates than we ever had before. That obviously knocks on to a cost of living crisis and impacts massively on real wages and therefore consumer demand. Again, we were talking about this with one of the people on the call before we went live, that's clearly impacting businesses in certain sectors. We've obviously got the ongoing war in Ukraine, creating still a whole raft of uncertainty, and particularly over energy prices and some material prices in certain sectors. And then again, we've got inflation and wage pressure still making things difficult out there. Again, we hope that inflation is beginning to reduce, but it's clear from the conversation we were having earlier that is still making life very tough. What we are seeing, which is a sort of a non-insolvency point, is that we're still seeing this hangover from COVID causing the owners of viable businesses to consider cashing out. We're still seeing people who have reassessed their priorities and thinking, do you know what? I would rather have some money where I can see it and spend time with my family. And we've got a team that specialise in insolvent liquidations, so MVLs, members voluntary liquidations, and we're still seeing a lot of interest in business owners considering MVLs. They're talking to their accountants, they're talking to the guys at Harts, because it's still very tax efficient to take that money out through an MVL and only pay capital gains tax on it, as well as potentially qualifying for attractive reliefs like business asset disposal relief that Stephen and the guys will be able to advise you on far better than I can.
But I have to say, can I echo that as well? Because I can say that we've seen a big uptick in people wanting to sell businesses. We're working on a couple of sales at the moment. So it is happening out there. It is interesting to see that there is a lot of activity going on. So yeah, I agree with you, Rik.
I think the other thing is that obviously we've got a general election coming this year, and there seems to be a fairly high chance that we're going to have a change of government, and the murmurings out of Labour have always been that capital gains tax is something that they would consider looking at, and so again, you know, we are dealing with MVLs now where shareholders are coming to us and saying, I want this done before the election because I'm not willing to take my chances that capital gains tax might go up to income tax rates or whatever it might be. So, you know, without sort of crystal ball gazing or becoming political about this, we're undoubtedly seeing that as a driving factor that is pushing up the number of solvent liquidations that we're dealing with. So, yeah, we're still seeing a lot of that, and it's you know, it's not surprising that that's echoing what Stephen's seeing. So that's a little bit in terms of the kind of the current market. HMRC are always a big factor in this. They're always the first people to get pushed to the back of the working capital queue when cash is tight. As I say, we have a team that specialise in negotiating time to pay arrangements. They're talking to HMRC all day, every day. So we've got a load of really hands-on, practical, up to the minute experience of what HMRC are up to. Time to pay arrangements have been around for a long time and will be here for a long time, you know, still to come. Pre-COVID, typically we were only seeing about 12 months in terms of time to pay arrangements for reasons that I've touched on. Since COVID, far more supportive, and you know, we've been able to get time to pay arrangements through of 3 years, you know, quite comfortably. The caveat there is where the debt is considered large, and the magic number here is 350,000. Where we've got debts over that number, then HMRC are much closer to it and will rapidly escalate those to the enforcement and insolvency teams if those debts are not resolved in a timely manner. And typically, and this is really counterintuitive when I sort of have this conversation, typically we're only getting a time to pay of a maximum of 12 months, which seems bonkers if that's the bigger numbers. But I guess HMRC are sort of going for the low-hanging fruit and saying, well, look, if you owe us £1 million, you know, we really want to get our hands on this sooner rather than later. So that's an interesting sort of little weird one of, you know, whoever understands how HMRC act. But that is what we're seeing. The other thing we're seeing that is far less common, but far more worrying actually, is HMRC are still issuing what we call notice of requirement for security letters, which is sort of the old VAT bond. Particularly, we saw it in Phoenix businesses where we'd had a new code come out of an insolvency, and HMRC were effectively looking for 3 or 6 months VAT to be put in an escrow account and basically held safe to cover an amount of VAT. That has come back, and we're seeing more of it. Our debt advisory team have a very, very high success rate in appealing them, but they are very serious. If you don't do something about it, potentially you're on the hook for some pretty sizable penalties. So if you do ever see one, please don't ignore it. Make sure that you're talking to Stephen and the guys at Harts, because things can be done, but it's not one to be ignored. The other thing that, again, just focusing on HMRC, I touched on it previously, is through winding up petitions. If you look at the graph on the slide, we've had a significant rise in the number of winding up petitions and threats and visits from enforcement agents, particularly since the middle of 2022. Just to give it some context, if you look at the blue bar, which is at the HMRC winding up petitions, in the whole of 2021 alone, HMRC filed just 15 petitions, 15. In Q4 2023 alone, there were nearly 1,500, of which HMRC issued over 1,000 of them. So nearly 3/4 of those winding up petitions were issued by HMRC, and that was the highest proportion in the last 3 years. So HMRC very, very much playing catch up now. And they are very much bearing the teeth in terms of trying to recover some of those significant debts that are out there. So what does that mean? Well, the increased winding up actions plus the current economic challenges that we've touched on, undoubtedly making life tough and increasingly tough. Per the London Gazette, the total number of company insolvencies in Q3, which is the most up-to-date numbers we've got, 6,200, pretty much level with the figure that we had in Q2, but 10% up on what we saw in Q3 of the previous year. 80% of those company insolvencies were liquidations, so CBILS. And it's just worth noting that the number in Q2 and Q3 were the highest since they started recording these numbers back in 1960. So we've very much seen an awful lot of liquidations in the last 12 months. I guess what else we're seeing, and this is, I suppose, is not surprising, but it's encouraging in a positive way, is that we're now having more distressed conversations with viable businesses. And I don't mean that in a daft way. The fact that advisors and business owners are coming to us for advice earlier is a really good thing. It's a message that we've always pushed, that the sooner business owners see a problem coming, even if it's many months down the line, and start to talk about what their options are, the more options they have. And we've got a much greater chance of keeping control of a situation if business owners have some idea of what options might be. So it's a really positive thing that business owners are talking to us now, and talking to us about positive restructuring options like administration and CVA, which hopefully with enough planning, make sure that even if we have got some kind of insolvency process coming, directors and business owners are still in control of that situation and can do it on their terms wherever possible. The other thing, I guess, from a positive point of view, is that where we are having an increasing number of insolvencies, that will undoubtedly present opportunities for acquisitive businesses. So for those of you out there who are sat on cash and who are able to move quickly, there will undoubtedly be bargains to be had. And we see more and more where we're having conversations with the kind of corporate finance community in this point in a cycle, who are saying, look, we've got clients who are interested in growing, they've got cash, they'd be keen to have a conversation with you if you've got businesses in this sector who are going to be going through a process. So if that's the sort of fits the mold of your business, then undoubtedly keep an eye on that. And if you're in the market for stuff like that, let Stephen know. We have a mailing list of where we advertise all the distressed businesses that we're dealing with. And if you want to see things like that, then let Stephen know. We make sure that Stephen's seeing that mailing list. In terms of the sort of the insolvency stuff, as I say, for some time now, what we've been seeing is an awful lot of liquidations, and a lot of liquidations that are companies with very few assets, but effectively just a bounce back loan and some debt to HMRC. These businesses that either are affected by the economy or just run out of steam or really never recovered from COVID. A load of those COVID victims, effectively, from a corporate point of view, hadn't really traded much. So really, they hadn't. The only creditors that they had were a big chunk of debt to HMRC and some money that they'd taken in terms of a bounce back loan. And it's a question that I guess get asked all the time when we're advising directors who are looking at a liquidation. They're saying, Rik, what is this a problem? We took out a bounce back loan. Do I need to be worried about that in respect of my actions as a director if we're going to put the company into liquidation? The simple answer is that loads of businesses took bounce back loans. Probably people that are on this call today did. The vast majority of those business owners did so with nothing but the best of intentions. What we're seeing where we're dealing with liquidations of companies that have got a bounce back loan is that the normal rules generally apply. I suppose the two key questions that we have to ask is, one, was that bounce back loan correctly applied for? And two, was the money properly used? If the answers to those two questions are yes, then it's generally straightforward. It's really no different from having a small commercial overdraft. It's not secured and it's not personally guaranteed. So the directors have, there's no implications for the directors there. The caveat, I guess, is where the scheme was abused. And we have seen instances of bounce back loan fraud, and there's stories in the press all the time. In that situation, it's no different from any other, what we would refer to as antecedent transactions. So things like preferences or transactions at an undervalue, things that directors have had a case to answer forever, so bounce back loan issues are no different in that respect. The thing that has changed, I guess, is that what we're now seeing is the Insolvency Service are paying much more close attention to bounce back loans and are seeking to pursue those wrongdoers where they consider that to be appropriate. As IPs, we've always had to do a report on the director's conduct. What's changed is that now in that report we have a specific section which looks at bounce back loans, and again that's looking at both the eligibility for the money in the first place and the use of those funds. We're required to do our own homework and look at things like accounts or projections where there weren't any accounts, to make sure that the company had sufficient turnover to apply for the value of the loan that they had. And sometimes that's a bit of a grey area because not all companies had decent forecasts. We had to look at the application form. We have to look at the bank statements so we can analyse, what happened to those funds. And critically, it's what was the money used for? Was it business or personal use? And again, that's no different from business owners taking money out of the company and spending it on themselves. In insolvency world, that money is an asset of the company. It doesn't belong to the directors or shareholders personally. And where we conclude that there might be a case to answer, then what we're finding now is the Insolvency Service are wanting copies of our working papers, and they're then making their own judgments on whether they want to take further action over directors. And the reality is that undoubtedly they are taking action. I read a good article at the back end of last year in the paper that claimed that over 50% of the 1,200 something directors' disqualifications that took place over a 15-month period had some kind of alleged fraud or abuse of a COVID support scheme. We know that directors are being disqualified. I read about one case where the director got disqualified for 13 years. To put that into context, the maximum disqualification is 15. So that director properly got the book thrown at him. Anecdotally, we're seeing an average of about 9 years for directors being disqualified. There is some leniency from what we're seeing if it's repaid, but not very much. There's the possibility of a time to pay. So there's a little bit of kind of room for manoeuvre there, but not a great deal. And again, it's just worth reminding that the action can be on either or both of eligibility or use, for use of that money. We are seeing the Insolvency Service seeking compensation orders, so effectively getting the directors to repay the amount overclaimed personally. Again, anecdotally, they might be less aggressive where that overclaim was less than 25%. But it's a little bit of a moving target. And in the most extreme fraud cases, we know that the Insolvency Service are pursuing, taking criminal cases. And we saw one where somebody got a 2-year sentence. The practical problem as IPs is that in reality, the use of these funds, these bounce back loan funds, is not always black and white. It's dead easy if we had the money went in on day one and then went straight out to the director's personal account on day 2 to pay for the daughter's wedding or for getting that decking done or whatever it might be. Some of the stories that you read about in the paper or hear from your mate down the pub. The problem is that in the vast majority of cases, the bounce back loan money just went into a company bank account. It was washed through over time. It was used to pay wages and salaries, buy raw materials, keep the lights on. Effectively, what that bounce back loan money was was designed to be used for. That is the vast majority of the cases that we see. And in liquidations of those kind of situations, that's unlikely to cause any problems. What we do see, though, are those grey areas and the conversations that we have with business owners of these grey areas. Things like where the bounce back loan money was paid into an overdrawn bank account that had been personally guaranteed by the directors. 1 minute we've got an overdraft with Barclays or an NatWest of 25 grand. We'd pay a 50 grand bounce back loan in from same bank, and suddenly the bank account is 25 grand in credit. In theory, by removing that overdraft that had been personally guaranteed by the director, in theory, they've preferred themselves in insolvency world. But I'm not entirely sure what a director could have done to have prevented that, because all the bank is doing is saying, well, there you go, we're going to give you 50 grand and we're going to put it into the account. So I'm not sure how any director could prevent that. The other one that we see is where the bounce back loan money was used to repay a director's loan account, where the director said, well, I've been funding this business for years, so I'm going to take some of that back. Normally we would say, well, that's a preference in insolvency world. But again, what we're seeing now is that, the years have gone by, and, typically these, we're looking at liquidations now that are more than 2 years since the bounce back loan was taken out. And, we're out of time in terms of taking actions against directors for those sort of situations, unless we've got out and out fraud, which is, considerably harder to prove. Then again, I think we're going to find lots of cases now that are effectively out of time. What I would say is, this is still very much a moving feast. As IPs, we're going to, this is going to develop over time for months and years to come in terms of what we are expected to do in terms of, looking at bounce back loans and taking action against directors. It's clear that there are some significant sums outstanding, and the government have been given a brief and have been given significant funding to recover as much of that money as they possibly can. So it certainly is one thing that needs to be taken very seriously.
I think as well is that when these things were given out, the bounce back loans were announced, it was so easy. All you had to do was complete a 2-page form and the money was in your bank 3 days later. That it made it so easy, and everyone said, well, there's no guarantees, you've no personal guarantees for it, take this money and use it. And to be fair, we've had clients who've used it and didn't even realise that they shouldn't have just taken it all out of the business for whatever reason. So there was a lot of confusion, I think, over the period, and it's only now where it's actually coming home to roost. I think it probably made it a little bit too easy for everybody to get their hands on the money. Yes, there was a lot of fraud, but there probably could have been a bit more information about it at the time, and the fact that they were saying that there's no guarantees, you don't have to personally guarantee everything. Well, it's now coming home to roost. Well, in fact, yes, there is, if you don't use it the right way. It's not the banks that are going to come after you, it's the insolvency practitioner and the insolvency service that will come after you.
Yeah, absolutely. Just to sort of wrap up then, I suppose it's clear that we've got some real challenging times ahead, even for good businesses. So it's really, really important that you guys as business owners stay in control. Don't forget that the failure of a key customer or a key supplier could have a real impact on your own business. So make sure that you take steps to protect yourself. Things like monitor key suppliers, make sure that you've got multiple sources of a key service or a key raw material. Monitor your customers, make sure that you're doing credit checks where possible. Think about credit insurance if you've got, particularly large exposure. Make sure that you've got good credit control procedures so that you're keeping on top of your debtors. Make sure that your terms and conditions are robust. We've got things like retention of title where you are selling a product. And if you're looking at putting more of your own money into your business, make sure that you consider taking security, so that at least you've got some protection if you ever then need to get that money back out again. If you're under pressure or if you see it coming, then don't panic, is what I would always say. These challenges can still be managed. And going back to a point I made earlier, the sooner that you can take action and take advice from Stephen or myself, increases the chance of making sure that you stay in control. And it's all about making sure that you guys stay in control. Have a plan. Make sure that you review your performance against it so that you know where you are. I know Stephen talks about this all the time. It's absolute best practice. The best businesses closely control costs and they monitor cash. Again, I'm sure I'm taking one of Stephen's previous slides from previous presentations. The 13-week rolling cash flow forecast is a brilliant discipline, but it gives you that early warning sign of any impending cash problem or any building creditor pressure. What I would say is if you need to take action, then do it quickly. And where we've got difficult situations, make sure that you're keeping key stakeholders like your banks and key suppliers, keep them on side. And where you are getting time to pay, be it formally through HMRC, or if you've got, informal time to pay arrangements with key suppliers, make sure that you keep those promises, because that gives you an awful lot of credibility. But even if you need to come back and revisit them, keeping people on side is the greatest chance of keeping their support. Make sure that you make the most of your funding, so don't sit on any unnecessary assets. Liquidate them if you need to, and make sure that you're talking to Stephen or to ourselves in terms of reviewing any funding facilities to make sure that you're getting the most out of them that you possibly can. And the final point that I would make, and this is, if you take nothing away from what I've whittled on about for the last 20 minutes, other than this, then my job is done. Don't let a viable business with a problem fail. Make sure that you take advice early. And by doing that, that maximizes the options that you've got and increases the chances of making sure that you stay in control. That, I think, is all I wanted to say. There's a couple of contact details on there, myself and Chris Knott, who Stephen knows very well. Stephen heads up our Stoke office that we opened back in the summer. So you've got our contact details on there. Always happy to chat to anybody, officially or unofficially. Happy to kick ideas around. There's no commitment, no cost to a phone call or a meeting. We're just happy to try to help Stephen and the team make sure that we're adding value to the Harts clients.
And thank you very much. Yeah, I mean, I'd only echo that point about planning. And I know in the past where I've worked with a client who was struggling temporarily, we actually did a daily cash flow forecast to make sure we could get through the next literally 3 weeks, and it works because then you can play around with who's going to get paid when and how much, and it does work, and eventually get that out to weekly and then monthly and so on. So doing cash flow forecasts and projections is something I'm very passionate about, and understanding your numbers as well. So you watch Dragon's Den, you see people turning up, don't know the numbers, and they don't get any investment. And it's much the same here. If you don't know your numbers, you don't know what your plan is, you're not going to get any funding. So do management accounts, understand some management accounts. There's an ebook from our website, another one on management accounts. If you want, just pop in your email address and download that, and we're happy to help. Has anybody got any questions, anything they want to ask Rik? This is interactive. Please feel free to either use your chat box if you're feeling a bit shy, or if you want to actually unmute yourself and shout out, now's the time to do so. Or if you want, we can stop the recording, and anyone who wants to chat to Rik afterwards, he's going to be around for a few minutes just to be able to chat to anybody who wants to. So has anybody got any questions that they want to ask? Yeah, fire away.
Yeah, it might be more for Rik privately, but it was more to get to grips with directors' personal liability. We're a property company, so we're a property trading company, and we've got a potential large liability to HMRC, and I'm just concerned about my responsibility personally for any debt owed to HMRC if our company was to go into maybe a voluntary liquidation. I wouldn't want to be in a situation where I personally become liable for tax owed by that company to HMRC.
Yeah.
And so it was really trying to get to the grips of that. And also there's a property asset within that company that we're currently looking at transferring out, and we're just making sure that we do it in the right way in terms of making sure it's at market value. And then so it's quite involved. So which is why I say it might be more for something to chat about with Rik privately, just to give a bit more detail of that.
Well, yeah, I mean, yeah, probably easier to do it offline. Have you got my? I mean, Stephen can give you my numbers on that slide if you've got it.
I've got your mobile number.
Yeah.
Is it if I give you a call on your mobile number? Maybe.
Yeah.
Are you free any point today, or?
Yeah, give me a call. Give me a call. I mean,
Right.
the simple answer is all the typically directors aren't, directors of limited companies are not personally liable for the debts. Is a simple answer. So typically, that isn't a sort of an issue personally, unless directors have been silly or the things that I talked about on the slide. And so, transferring assets around, the terms you use about market value, what have you, is the right things to be talking about, because the things that where directors normally come unstuck is trying to sort of move assets around and not pay for them, and taking value out of a business and then it going into insolvency. That's where directors come unstuck. But doing things at fair value is typically the right way to be approaching it. So, but yeah, you've got my number from there. Give me a call whenever I'm in and about, and we can happily chat through offline.
Okay, that's great. Thank you.
Lovely. Anybody else got anything they want to ask? Any questions? Typically, I've just got one which might affect a few people. Rik, what happens with overdrawn directors' loan accounts? What's the current attitude towards those?
So the simple answer is that an overdrawn director's loan account is technically an asset of the company, and so where we're liquidating that business, the starting point is we've got to ask for that debt back. It's arguably no different from from one of your customers. I suppose the couple of issues that throws out is the director's ability to repay that. And so, we'll always sit down with directors at the outset, and I would much rather that we all know if there's a problem on the table. I'd much rather we get it on the table straight, up front, rather than further down the line, and we can then understand what the director's personal position is in terms of being able to repay that debt. We'll always take a commercial view in terms of giving people a period of time to repay that where that's required. The other thing that's always just really important to be aware of is, and this very much impacts on the sort of stuff that the advice that Stephen and the team would be giving, is that where directors' loan accounts are written off, or elements of that director's loan account is written off, there's potential tax consequences for the director individually. So the potential is tax to pay for the bit that's written off. So again, we want to make sure that people are aware of any implications for themselves personally from a kind of self-assessment point of view, and we don't want to leave anybody with any nasty surprises further down the line. So the simple answer is, where we've got directors' loan accounts that are overdrawn and we see them all the time, we want to make sure that we're having a sensible conversation with the directors up front to agree a plan for how we're going to deal with that.
Great, thank you very much indeed. Well, that brings us to the end of today's webinar, which I hope you've all enjoyed. Look forward to seeing you on the next one, which is on the budget, in March 12th. And if you've got anything else that you want to chat about, we'll be offline shortly. But it only remains for me to say thank you very much, Rik Heap from Leonard Curtis, for a fantastic presentation. Very informative. Thank you very much indeed. And we'll look forward to seeing you soon. Have a great day.
Thank you.
Thank you very much.